In this video, we're going to talk about Senseonics. If you're considering buying Senseonics shares in your portfolio, then please keep watching this video until the end, because it'll cover many of the factors that should be considered regarding buying, holding, or selling the shares. During the most recent trading session, the stock opened at $2.14 and closed at $2.09. The lowest point at which it fell to was $2.03. And the highest point it rose to was $2.15. Compared to the current price action, its 52-week low was 35 cents, and the 52-week high is $5.56. The current trading volume of Senseonics is 19.6 million shares, compared to the average volume of 22.6 million shares. Overall, the trade volume of Senseonics shares remained mostly constant, with a slight decrease compared to the average. Given that the stock is currently recovering from the recent pullbacks, I would say that this is a normal phenomenon. From the short-term perspective, Senseonics still seems to be in a price correction compared to where it was earlier in the year, to prepare for a continuation of the bullish run. However, in terms of the long-term trend, it seems that the company has a ceiling at around $4, since that same level has been reached back in 2015 and 2018, before triggering massive sell-offs and pullbacks. In other words, the stock has been in a relatively downward trend if we zoom out for a horizon between 5 to 6 years. The company does have reasons to go upward, but I would say that buying Senseonics shares at the price point now is to assume that it has changed from an overall downward trend to an overall bullish one. If that is your assumption, then I would suggest to buy a small position now and to wait for more signals of rebound. Alternatively, you can also wait for a few weeks and month, possibly corrects back to around 75 or even 50 cents before buying more. From the price actions pattern, it would be up to you to determine if the stock still has enough steam to go upward, regardless of the company's fundamentals. The assumption is that they're all priced in. Now, let's take a look at the enterprise value of the company, which represents how much of the company's assets are worth once the debt is removed from them. The EV, or enterprise value, remained constant over the years but increased significantly during 2020, going from around $125 million to almost $800 million in present day. In other words, the company now has a lot more going on compared to what happened a year ago, and this is mostly due to the development of operations from capital it managed to raise from equity sale. Another outside signal is to observe the total number of shares outstanding. Generally speaking, if the number of shares keeps increasing, then it suggests that a company is selling the equity to keep the company afloat. The total shares outstanding of the company increased over time, but less significantly than the increase of enterprise value during the same period of time. From 230 million shares in 2020, it increased to 428 million shares in the present day. This means that the stock has not been massively diluted, or rather, the shareholders owning the stock has not been massively diluted during that period of time, because the company's value per share has increased during that same period. Meanwhile, the financial market's overall sentiment is still relatively reluctant at putting more money into this kind of company. Following the stock market craze back in 2020, the stock market decided to pull back massively from the entire disruptive and innovative growth stocks, covering biotechs, EVs, and anything requiring keynote presentations to attract capital. This wave of pullback can be explained in two ways. The market needed niches to park their capital inside to avoid getting heavy losses, and since the stock price of many of those kinds of companies increased multifold, many of them decided to lock in the profits and didn't mind the massive sell-off that it would initiate. The second reason was because the market began to realize how overly exposed the investors have become to the growth stocks. These are the reasons, or at least the main ones, regarding why the stock ultimately collapsed for so many companies that everyone was talking about. In the current circumstances, the recommended approach is to be careful when buying stocks. On one hand, the stock may be able to climb back on its own when operations begin to carry the stock price. On the other, the stock may simply increase because it fell too low. This means that in the current market settings, we need to tread the water carefully regarding when and how to buy shares. Many of them became overpriced over the past 12 months, and we may need to wait for another few weeks or month before the timing is ripe to increase our holdings. With that being said, there will always be sudden events that will create a lot of volatilities for individual companies, and this is why it's recommended to keep a small position in those stocks, just in case you fear about missing out. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.